Right, so welcome to our live stream today as we continue with our discussion on the consolidated financial statement. We're looking at how we can prepare the consolidated financial statement after going through the 4 sessions where we explain all the principles and the concepts that we need to understand when it comes to preparing. Oh, getting some feedback here. Right. So we're looking at how we can prepare the consolidated finance. Consider the issue about the consolidated income statement, the consolidated income statement. And today we want to look at the consolidated statement of financial position. The highlight of yesterday's discussion was that when you are preparing the consolidated income statement, you need to take into consideration the various adjustments that has to be made. But most importantly, any total intra-group sales has to be deducted from the revenue and then the cost of sales on the consolidated financial statements. But most importantly, also at the end of the day, when you get the profit, the consolidated profit, a portion of that has to go to the non-controlling interest. Then the balancing figure goes to the controlling interest or the parent entity in that case. So we looked at that question. So today we want to look at yet another question, and I see some of you guys joining us on YouTube. You are welcome. Comment in the chat box any questions you have for me, and then also give us a thumbs up on the video. For those of you joining us on the Zoom call, please note that if you have any questions, you can raise your hand. I will call you up, then you speak. However, ensure that you don't have noise in your background. If you have noise in your background, then you can leave your questions in the chat on Zoom, and I'm going to be reading all of your comments and answer any questions you have. But if you know that your background is okay, because we are streaming on YouTube and we didn't want to have a lot of noise in the background, you can raise your hand and I'll call you up and you'll be able to join the stream in that case. So let's go straight up into our question for the discussion as we continue with that case. Richmond Ahovi on Zoom said, good evening, sir. God richly bless you. Amen. Good evening and God bless you too, Richmond. And thanks for joining us in that case. So let me share my screen with you and let's go straight up into it. Let's get excited about it. We're looking at how to prepare the consolidated statement of financial position, the consolidated statement of financial position. And again, a number of things will be coming up here, how we do goodwill and how we go through the entire thing, and you will see how we go through it. So let me share my screen and let's get excited about it. Like I said, if there are any questions, raise your hand. I'll bring you up on Zoom. And then those of you watching us on YouTube, put it in the chat for me, and I'm going to be reading all your comments in that case. So bringing up my question on my screen first, then we go. Come on, what are you waiting for? Okay, so let's see. What's going on? Give me a moment. My iPad not connecting. Let's see. All right, we got it now. Coming up. Right, so we see it on our screen. Let's get excited about it, and then let's go into right. So we want to look at a question relating to the consolidated statement of financial position. And the question we are looking at today, it's called Piquant. Now, for those of you who are learning under my mentorship, you are enrolled in our full course on the portal. Financial reporting students, you can get a question in your question kit, and that is on page 153 of your question kit. So you just go to your question kit. The name of the question is Piquant, on page 53 for the FR students. Then for the corporate reporting students, CR, you're going to get it on page 57 of your revised kit in that case. Other students, you can download the question. I'm bringing up the QR code in a moment, and you can scan the QR code. That is it on your screen. You can scan it, and then you'll be able to download the question real quick and get access to it. Alternatively, you can also just Google, this is ACCA June 2010 F7 question. F7 is financial reporting in the ACCA. You could just Google that and you could download it or scan the QR code and you will be able to get access to the question in that case. Okay, so there you go. That's it. So piquant. So corporate reporting students is in page 157. Financial reporting students is in page 153. And then you can get access to it in that case. So let's go. Let's read the requirements so we know what we are getting ourselves into. So this is just for 15 marks, but then you're going to see that for a 15 marks, we have a lot of things coming in for our 15 marks in that particular case. So let's see. We are supposed to prepare the consolidated prepare the consolidated statement of financial position for piquant. The consolidated statement of financial position for piquant. Okay. So immediately I hear preparing the consolidated statement of financial position, quickly I need to ask myself, what are the things I'm going to be on the lookout for? Yeah, definitely I'm going to be interested in the group structure. Okay. I'm going to be definitely excited about the net assets of the subsidiary so that I can get a post-acquisition profit. But I'm going to show you another way that you can go about that so you don't have to go through it. So the net asset schedule. Okay, definitely there is goodwill I need to calculate. Most importantly, goodwill at the reporting date. Why? Because we are preparing the consolidated statement of financial position. I know I need a consolidated retained earnings or the group retained earnings. Definitely, I will need the non-controlling interest at the reporting date as well. Then any intra-group trading, I would have to deal with it in that case. So because I'm preparing the consolidated statement of financial position, these are some of the workings that I'm going to be bringing out or that we are going to be doing when it comes to dealing with this particular question in that case. When it comes to dealing with this particular question in that case. So that these are the key things that we are going to be looking out for this question. So let's go back and let's start to read our question. Like we did yesterday, we're just going to be reading it piece by piece, building it up, reading it piece by piece, building it up as we go ahead. And before we know it, we will be done in that case. So let's go. On April 2009, Piquant acquired 75% of Sunday's share. Okay, so let's begin. We're already in already. So Piquant. And I'm going to be setting out my workings. So definitely the workings one, I'm going to have my group structure coming in. And Piquant is the parent entity. Slash that down. We get Sunda, subsidiary. We are told that from the preamble, Piquant is acquiring 75% share, right? So that is 75%. So it means non-controlling interest, it's going to be 25%. But it is very important for us to understand also that the date of acquisition is 1st April 29. And then let's ask ourselves, what is the reporting date? The reporting date we are preparing the financial statement for is what? 31st March 2010, right? 31st March 2010. So April to March, 1 year. So it's a full year acquisition. It's a full year acquisition. So there is not going to be any proration when it comes to dealing with a post-acquisition profit of the entity in that particular case. So we're going to just bring it up in that case. So that's the group structure coming in. We get a date of acquisition. We get a post-acquisition period. We have the non-controlling interest and we have the controlling interest. Let's continue and let's build it up. Back to the preamble. In a share exchange, in a share exchange of 3 shares in Piquant for every 2 in Sanda. Okay, so immediately I hear that, that is fair value of Ibaze, consideration transferred. So workings number 2, fair value of consideration transferred. So how do we get that? Slashing our currency sign, simple. Are we working 3 zeros up? Yep, we working 3 zeros up. So you bring it in, then you bring in the share exchange. Remember, we mentioned that in the share exchange, you use the share price of the parent entity. But let's see the policy. They said they give them 3 for every 2 that they acquired. 3 for every 2 that they acquired. So it means that they acquired 75% of the shares in Sanda. So to know the shares in Sanda, we scroll down to look at the equity. When we look at the equity, what is in the middle here is about Sanda, and that is 8,000. So we take 75% of 8,000, and then we will give them 3 for every 2 acquired. So that's going to be 3 over 2. We're going to multiply this by the share price of the parent. As of now, we've not been told the share price. So let's go back to the question. So let's see. The market price of Picant and Standard share at the date of acquisition is, 2.3. That's what we are excited about. The share price of Picant, 2.3. So we're going to multiply this figure by 2.3. Are you getting it? So that is the share exchange. That's how we determine the share exchange. So when we punch this out, you can confirm this figure for me. Per my working slide, I'm supposed to get 28,800. So you can check it out and let's see what we got there. 28,800. So far, with the first paragraph in the preamble, that's what we can do. This is what we can do. Let's continue. Now, note something here. There are 2 things you got to pay attention to anytime there is share exchange. Chances are the parent had already recorded it. In other scenarios, the parent has not recorded it. Now, assuming the parent has not recorded this share exchange value that we've had, 28,800, then when we are preparing the consolidated statement of profit financial position, it will be added to the parent's equity shares. Because remember, in the statement of financial position, when we are looking at the equity, you bring only the parent's equity figure in the statement of financial position. So if they had not recorded this, or if they haven't, we don't know the statement. If they haven't recorded it, we will come and record it. But if they have already recorded it, no cause for alarm. As we read the question, we will realize whether they have already recorded it or they have not, and we are going to be making the question under that. Okay, so YouTube, I see some of you guys joining. You are welcome. Give us a thumbs up on the video. And then we see some comments coming in. Good evening, sir. Your lessons really help. All right. Jonas, thank you. Chemoka said, good evening, sir. I greatly appreciate your lectures from Zambia. That's awesome. Thank you very much. Please, how do I download the question paper? The share price is 3 points. Okay. That's true. 3.20. Thank you. Not 2.3 as I wrote down. Right. How can I download the question? We said that you can download the question from, now, for those of you on Zoom, make sure you are muted because we have configured everything that when you enter, you will automatically be muted. So you don't have to unmute yourself unless otherwise you have a question and you raise your hand. Make sure you don't have noise in your background so we don't have feedbacks coming in that case. You can download the question by scanning this QR code. You can scan this QR code. For those of you who are already enrolled in our financial reporting or corporate reporting book, you can get it in the question kit. Financial reporting students, you can get it on page 53. And then corporate reporting students, you can get it from page 57. This is for those of you who are enrolled in our corporate reporting and financial reporting courses and studying directly under my mentorship. So Jonas, no, that is not Jonas. Abigail Agri. I hope you have the question now. You scan the QR code to download the question. Alternatively, you can just Google ACCA F7 June 2010 past paper, and it's an ACCA question. It's a past question, and you can simply download it. So let's go. So that's the first paragraph. We good. Let's continue. In addition to this, so in addition to the share exchange, there is something else going on. Let's see. Piquant agreed to pay a further amount on 1st April 2010. Now, stay with me carefully. Further amount on 1st April 2010. What does that mean? It means that is going to be what? A contingent. Okay, that is going to be deferred payments. But let's see the statement. That was contingent upon the post-acquisition performance of Sander. So stay with me carefully. Piquant is going to pay an additional amount 1 year from now, but it is dependent on they meeting a certain performance criteria or based on their performance in the post-acquisition period. Let's see. At the date of acquisition, Piquant assessed the fair value of this contingent consideration to be 4.2. Okay. But by 2010, it was clear that the actual amount to be paid will be only 2.7 million, ignoring discounting. Now, stay with me carefully here. So at the date of acquisition, they said, oh, we're going to pay 4.2. The examiner said we should ignore discounting. Remember in yesterday's question, there was deferred consideration and we discounted it into present terms and we did unwinding. In this case, the examiner said, just ignore discounting. So we're going to take the 4.2 million and add it to the fair value of consideration transferred. Okay, so that is contingent consideration. And bring it here. And that is 4,200. 4,200. Now, stay with me. Stay with me. The examiner said that by 31st March 2010, which is the year we are preparing, or the year ended we are preparing the financial statement for, it was clear that the actual amount to be paid is 2.7. Now, as per IAS 37, provisions, contingent liabilities, and contingent assets, a reduction in provision is an income to the entity. So instead of 4,200, they are now going to pay only 700. That means there is a gain. So that reduction in that contingent payment becomes a gain, which we have to take to the consolidated retained earnings. So let me set it up because I don't want to forget it. So I'll just say workings 3, the consolidated retained earnings or the group retained earnings. Because I don't want to put it somewhere else. I'm going to do consolidated retained earnings anyway. So let's just bring it up. So we go. Now, to make it clean on myself, I can decide to just jungle it in and bring whatever I have to bring. So reduction in contingent consideration. So reduction in contingent consideration, that's going to be 4,200 minus 2,700. And that is going to give us an amount of, let's see, 4,200 minus 2,700. That's 1,500. That is going to be added to the group retained earnings. Why? Because that is a reduction in the contingent consideration. Now, you got to be careful about that because right now, what it then means is that when we go to the statement of financial position, it is the 2,700 that is going to be what going there. And I'll get into that later on. But that is the treatment for that particular item there. Piquant has recorded the share exchange and provided for the initial estimate of 4,200 for the contingent consideration. Listen to the keyword. They have recorded. Assuming the examiner said they have not recorded, that was what I was telling you, that this 28,800 would have been added to the share capital by splitting it into share capital and what? Share premium. Because you realize that the nominal value of the loan note is $1, as stated in the question here, is $1 each. But then the share price was 3.2. So it means 2.2 will go to share premium, and then $1 will go to the share capital in that case. But they've already recorded it, so we're not going to be thinking about it any longer on the face of the consolidated financial statements. Any questions? If you have any questions, for those of you who are joining on YouTube, you just comment in the chat. I'm going to be reading all your comments. And those of you on Zoom, you can put it in the chat or you raise your hand. I'll call you up, subject to the fact that you don't have a lot of noise in your background, and I will answer your questions. Philip Apia said, thanks, Nhyira, for letting me in. All right, you're welcome. So let's go. Let's go back. So that's the second paragraph. We are done. Let's go to the third paragraph. On October 1, 2009, Picant also acquired 40% of the equity shares in Adler. Okay, they are acquiring how many? 40%. Okay, so immediately I hear 40%. That is an investment in what? Associates. Okay, so what do? We change our group structure, come and add Adler here, and that is 40%. But let's get excited about it. And the date of acquisition of Adler, we are told is 1st October 2009. And our reporting date is still 31st March. So how long is that? October, November, December, January, February, March. So Adler is 6 months acquisition. Now, remember, we are going to prepare the statement of financial position. For that reason, investment in Adler shall be accounted for in accordance with IAS 28, investment in what? Associate, using the equity accounting. So let's go. Paying $4 in cash per share acquired or per acquired shares. Okay, so I'll go straight up and go and do workings for, and that is going to be the investment in associates Adler. I want to set it up here, and we're going to be using the equity accounting. So let's look at the first thing. They said they paid cash of $4 per share acquired. So cash consideration. Now they acquired 40% of how many shares does Adler have? We go to the financial statement and Adler has 5 million or 5,000. So we take 40% of the 5,000 and multiply it by how much they paid per share. That is $4. Okay, so 40% of the equity shares of Adler, that gives us the number of shares they acquired. We multiply it by the money they paid per share, and that gives us that figure there in that case. So when we punch that out per my working slide, that's going to be $8,000. Let's go. And issuing at par $100 7% loan note for every 50 shares acquired in Adler. Oh, okay, so the Adler acquisition is financed by cash and also by what? Issue of loan notes. So let's get excited about it. So a 7% loan note, and we are told that for every share they acquired, sorry, $100 bond for every 50 shares they acquired. So what do? This is what we do. 40% of the 5,000 gives us the number of shares they acquired. So when we divide that by 50 times $100, that will give us the nominal value of the loan note, because every 50 shares, we issue $100 loan note on that, and that is going to give us an amount of 4,000, and you can check that up as well in that case. So 40% of the 5,000 gives us the number of shares we acquire. Then every 50 we give 100. So we divide it by 50 and multiply it by 100 in that particular case. Then we go. The next thing is that this consideration has also been recorded by Picant, and Picant has no other investment. Okay, so We add it up, and this gives you the fair value of consideration that they paid in ADLA, or we can say cost of investment in ADLA. Normally, that's how we'll call it. So the cost of the investment will be 12,000. Okay, so it means that our fair value of consideration is also sort of done. So we add it up. So 28,800 plus 4,200, and that's 33,000. Now I want you to see something. Stay with me carefully. The examiner said Piquant has no other investments. If you look at the statement of financial position, look at me. I want to show you something. The investment in Adler's account is 45,000. 45,000. So let's see if they paid 33 to Sander, and then they paid 12,000 to what? Adler. And 12 plus 33 becomes what? 45,000. Meaning that, yes, that is the true answers we've got for the cost of the investment, both in the subsidiary and in the parent entity. That is the preamble of the question, and we are done with the preamble, and these are the things we can done so far from the preamble. We have got our group structure coming in. We've got the fair value of consideration transferred, something posting to the group retained earnings, and also the cost of investment in the associate, which in this case is Adler. Now that we finished with the preamble like that, we could go back to the footnote and then start reading in that case. But since I know I'm preparing the statement of financial position, what is going to be happening is that I need to look at the net asset at the date of acquisition and at the reporting date. But remember, there is another way we could do that so we get a post-acquisition profit. I'm going to show you the two, and then you choose what you are okay with. So I'm going to do workings 5, and that's going to be the net assets. And that's going to be Sander, the subsidiary. Remember, with the net asset, is only the subsidiary that we bring always. So at acquisition, then at the reporting date, 3 zeros up, 3 zeros up. So let's bring in share capital real quick. So if we look at it, go to the statement of financial position, you will see share capital in Adler. It is called equity shares. So maybe let's just use the word that was used in the question. We will not be really punished for not using the right word though, but equity shares, 8,000 at acquisition, 8,000 at the reporting date. We go. Share premium. Okay, Adler, Sander does not have any share premium, so no P on that. But then the next one is retained earnings at 1st April. Stay with me carefully. Retained earnings at 1st April. That is at the date of what? Acquisition, which is the opening year. So that's going to be the opening retained earnings coming in that particular case. So it could be pre-acquisition retained earnings, something like that. We could call it that way. Pre-acquisition retained earnings. And that is an amount of 16,500. So you bring the same figure at acquisition, bring the same figure at the reporting date. Then we bring in the profit for the year. Look at it. You realize that the examiner said for the year ended 31st March 2010, Sander is making a profit of what? 1,000. So we're going to bring that profit. And remember, it's a full year acquisition, 1,000. Now, assuming it wasn't a full year, then part of that 1,000 will be brought to the date of acquisition. So assuming it is 9 months, then 3 over 12 by 9, 3 over 12 by 10,000 would have been recorded at the date of acquisition. Then the 1,000 will still be at the end of the year. But because it is full year acquisition, there will not be any profits coming in that case. YouTube, I see some of you guys joining. You are welcome. You see the number going up. Give us a thumbs up on the video on YouTube for those of you who are joining. And we are looking at a question on the consolidated statement of financial position. So just give us a thumbs up on the video and comment in the chat box any questions that you have, and share the video also. Let's get to reach as many students as possible on the live stream. Right. So from the statement of financial position, these are the things that I can bring up. Then we go back to the footnote to start with additional information. Let's go. At the date of acquisition, the fair values of Sanders property, plant, and equipment was equal to its carrying amount, with the exception of, stay with me, with the exception of Sanders factory, which had a fair value 2 million above. Okay, so immediately I hear above, it means I got to add it back straight up. I don't like to think a lot. So fair value adjustment, you make sure you write that in full. So plants, 2,000. It is above. So we added, they have understated their assets. So the fair value is more than the carrying amount by 2,000, because assets at the date of acquisition has to be carried at their fair value. So we added up. But let's continue. It says that Sander has not adjusted the carrying amount of the factory because of its fair value exercise. This requires additional annual depreciation of 100,000 in the consolidated financial statement in the post-acquisition period. Okay. So the depreciation has been done for us already. So post-acquisition depreciation. So additional depreciation, that's going to be 100, and that will be here. Now, like I told you, the net of this will be added to the consolidated statement of financial position, PPE, and that will be 1,009. Okay, the net of this will be added to property, plant, and equipment, and we'll look at that later on. Second part. Also, at the date of acquisition, Sander had an intangible asset of 500,000 for software in its financial position. Picant's directors believe the software to have no recoverable value at the date of acquisition. Oh, okay. It had no recoverable value. So if it had no recoverable value, they have included it in their assets. What do? We're going to take it out. So intangible assets in the name of the software, we will take it out 500. Okay, we'll take it out 500. Then we are told that Sander wrote it off shortly after the year. So that is no longer there. So at the end of the reporting date, that is no longer there. So we're going to just put dash there at the end of the year. That is footnote 1. That is footnote 1. That is footnote 1. Very sweet, simple, straight to the point. So realize that there is fair value measurement here, or there is fair value adjustment here. And these are the things that we do on that figure. Let's go to note 2. At the 31st March 2010, Picant's current account with Sander was 3.4 million debit. This did not agree with the equivalent balances in Sander's book due to goods in transit invoiced at 1.8 million that were sent by Picant on 28 March 2010. Okay. So who is selling? Picant, the parent, is selling to Sander. Oh, a lot of things. Oh, let me try to keep my notes a bit clean here. My pencil is misbehaving. Let's get everything right. Okay, so Picant is selling to Sander. Now, so in the books of Picant, they will be having trade receivables. In the books of Sander, they will be having trade payable. And we are told that Picant's current account was 3.4 debit. Now, trade receivables keep what? Debit balance. So what I want to do is I want to keep it clean. So I will do another workings. That could be working 6, reconciliation of the current account. Now, there is no need for me to do this. I could do this on the face of the financial statement, but I want to just show you what exactly is going on here. So we're going to have Picant on this side. And we're going to have Sanda here. So see how we do the reconciliation. So trade receivables is the one selling, which is Picant. We are told it is 3.4, debit 3,400. Now stay with me carefully. And we're going to bring trade payables. Now the trade payable is supposed to be under Sanda, but we don't know because the examiner has not told us, but there is a way we can figure it out. So stay with me, how we will figure that out. The examiner gave us a clue. He said that the reason why the figures are not the same, they are supposed to be the same. 3.4 in Picant, 3.4 in Sanda. But the reason why the figures are not the same is because there is a goods in transit of what? 1.8 million. Oh, okay. So goods in transit, I told you how we're going to deal with that. We push it into the account of the person supposed to receive it. So goods in transit will be in the account of what? Sanda. And this goods in transit will be added to inventories on the face of the statement of financial position. Then we balance this account. So when we balance this account, everybody is supposed to have 3.4. So the balancing figure will be the trade payable figure that Sanda is having in their books. And that is going to be an amount of 3,400 minus 1,800. And that is 1,600. That's it. That's it. So when we are looking at trade receivables, we will deduct this figure on the face of the consolidated financial statements. If we are looking at trade payable, we will deduct the 1,006 on the consolidated financial position in that case. So you deduct 3.4, you deduct 1,600. Then the goods in transit will be added to the inventory on the face of the financial statement. But even before I get excited about it, any goods in transit, what do? We take it, we have to calculate provision for unrealized profits. So let's see if the examiner gave us a clue. And since the parent is selling to the sub, any provision for unrealized profit will be taken to the group retained earnings. So let's see. But had not been received by Sanda until after the year end. Picant sold all goods at a cost plus 50%, at a cost plus 50%, at a cost plus 50%. So if they sold all goods at a cost plus 50%, we just calculate, go to the group retained earnings, bring in provision for unrealized profit, cost plus 50%. Now remember the 1,800 is the selling price. So we do 50 over 150. And you punch that out. And that should give you an answer based on my working slide here of 600. And the double entry for that is you debit group retained earnings. That's why we are deducting it from group retained earnings, and we credit what? Inventory. We credit inventory. So when we go to the statement of financial position, we'll take the 1,008 there, add it to the inventory, then we'll deduct the provision for unrealized profits, 600. So that is it also about the reconciliation of the current account from the note 2. Any questions? Put it in the chat for me, for those of you on YouTube. And for those of you on Zoom, if you have any questions, you can put it in the chat, or you can raise your hand. I'll call you up, subject to the fact that you don't have noise in your background, then you can speak. If not, you put it in the chat, because I'm going to be reading all your comments also here. Ivan, Picant's policy is to value non-controlling interest at fair value. Now, stay with me. Immediately I read up to that point that Picant's policy is to value non-controlling interest at fair value. It means any impairment in goodwill, it must be shared between the parent and the sub. Sounds good? Any impairment in goodwill must be shared between the parent and the subsidiary, because we are valuing NCI at fair value. At the date of acquisition, for this purpose, Sanda's share price at the date can be deemed to be representative of the fair value of the shares in the non-controlling interest. Okay, so let's go. Let's do workings for NCI because we're going to do that anyways. So non-controlling interest. Oh, non-controlling interest. Three zeros up. So at acquisition, we bring in the shares they own. Now from our group structure, we saw it is 25%. So 25% of the shares in Sanda, which is 8,000. Then we go and take the share price of Sanda, which was given in the preamble, 4.5. So you multiply that up, and for the NCI, I'm going to get 9,000 at the date of acquisition. That's it. That's it. So that is also about the footnote III, and we are done. IV. Impairment tests were carried out on 31st March 2010, which concluded that the investment in Adler was not impaired. Okay, so there, I remember I told you there is impairment in the associate and there is impairment also in what? The subsidiary. So the associate, there was no impairment. But due to poor trading performance, consolidated goodwill was impaired by 3,800. Okay. Remember I told you that consolidated goodwill, since NCI is valued at fair value, we will do CIMA. It means we will share it among them. So what we can do is that we could bring it on the face of the net asset schedule we are preparing. Where is it? Net assets, and subtract it at the end of the reporting date. So impairment in goodwill. $3,800 and deduct it here. The reason I'm bringing it here is that if I don't bring it here, then I need to share it between group retained earnings and then what? NCI. But if I bring it here and get my post-acquisition profit or loss, I share that and boom, everything is gone at the end of the day. Now, note that this 3,800 will also be deducted from goodwill to get a goodwill reporting date. But since we've not calculated goodwill yet, we're going to be looking at that in a moment. Then assume all profits accrued evenly through the year. So it looks like we are done. We are done with the footnotes. We are done with the footnote. Lamini said, "Sir, why are we deducting provision from PUP in group retained earnings since Pecan sold all goods?" Were we told Pecan sold all goods? Pecan is selling to Sanda, but Sanda did not receive the goods. And we said, when it comes to provision for unrealized profits, it is calculated on both closing inventory and goods in transit. So if the goods is in transit from Pecan to Sanda, then Sanda has not received the goods yet. Sanda has not sold those goods yet. So we have to calculate provision for unrealized profits on those goods. That is why we are doing the calculation on that and taking it into the group retained earnings, because the parent is selling to the subsidiary. So since we finished reading, we can just add up what has to be added up and then close the various account that has to be closed. So let's get a post-acquisition net asset at the date of acquisition here, net asset at the reporting date. Let's see what we got. 8,000 plus 16,500 plus 2,000 minus 500, and I get 26,000. Then 8,000 plus 16,500 plus 1,000 plus 2,000 minus 100 minus 3,800. And that gives me 23,600. Now, it means this results into a loss. So post-acquisition loss, and that's going to be 2,400. So this loss will be shared between the controlling interest and what? The group retained earnings. So I have NCI somewhere. So let me bring it up. Then I'll bring in the post-acquisition losses. They will take 25% of that to 400. Simply. And that gives us 600. And since a loss, we will deduct it. Then we will go to the consolidated retained earnings also and bring in the post-acquisition loss in the book of Sanda. And that's going to be still 400, but we take 75% of that. And that gives us an amount of 1,800. And you deduct that. Make sense? You deduct that. You deduct that. Then now that I have my net assets at acquisition and net asset at the reporting date, I need a net asset at acquisition so I can calculate my goodwill. So let's go to the next workings, and that's workings 8, goodwill. So let's bring it up with a percentage. So fair value of consideration transferred. That was from workings. We did a workings for that. Let's go pick it up. That's workings 2, I guess. 33,000. Workings 2, 33,000. That gives us 75%. Then we bring the fair value of NCI. And we did a workings for that in working 7, 9,000. That's 25%, 9,000. You add it up, that gives you the fair value of the business. And that's going to be an amount of 42,000. In that case, 42,000. Then we bring the net asset at acquisition. And we did a workings for that. Let's go pick it up. Workings 5, 26,000. Out. And that gives us goodwill at acquisition. And that gives us an amount of 16,000. But remember that there was impairment in goodwill of 3,800. So you take it out so that we can get an NCI at the reporting date. Sorry, goodwill at the reporting date. And that's going to be an amount of 12,200. So that's my goodwill. That's my goodwill computation. So realize that in the goodwill, 3 workings are coming in. The fair value of consideration transferred, the fair value of non-controlling interest, and then also the amounts relating to the net assets at the date of acquisition. Okay, is there any other thing that I need to do? Let's see. We go back to the group retained earnings and then finish it up. We've brought the reduction in the contingent liability. We've brought the post-acquisition profit there. We've brought the post-acquisition losses. Then let's bring Picant's own retained earnings for the period under consideration. Now, we could have brought that at the beginning, but I was just following the workings. So, and it doesn't cost you anything. So if we go back to the financial statements, we see that Picant's retained earnings is both 16,200 and then 11,000. So we're going to be bringing that up, and that is going to give us an amount of 27,200 in that particular case, 27,200 in that particular case. Then let's finish with Adler. You know, with Adler, we've not brought the post-acquisition profit. So let's bring in post-acquisition profit. Did they even make profit? Let's go. Yes, they made a profit of 6,000. 6,000. So remember, we acquired them from our group structure 6 months ago. So we will take 40% of the 6,000, and then we do 6 over 12. 40% of the 6,000, we do 6 over 12. That gives us 1,200. 1,200. So that figure will go to, again, the group consolidated retained earnings, share of Adler post-acquisition profit. And I could just refer to the workings we are doing here, workings for 1,200. It's going to be added in that case. It's going to be added in that case. So when we check here, we're going to be having 13,200. And that's the carrying amount of the investment in Adler at the end of the year. That will go to the consolidated statement of financial position. Okay. So it's like we are done with the workings. Okay. Yeah, it's like we are done with the workings. So we can now add up our things to get the consolidated retained earnings, because we've brought everything that has to be brought. When we add this up per my working slide, we should get 27,500, and that is the consolidated retained earnings. And yeah, NCI, nothing else is coming in. So let's get the closing figure, and that's 8,400. So that is the NCI at the reporting date that will go to the statement of financial position. Goodwill, we've got that covered. So we are done. We are done. So let's extract the financial statements. If there are any questions, put it in the chat for me. Peter Chanda on YouTube said, am I too late? You can watch the playback of the video. So the playback will be available on YouTube. So you can watch the playback always. So let's extract the financial statements really quick and remember all the things that we mentioned. So Piquant, consolidated statement of financial position. As at what's our year? 31st March 2010. So we're going to work with 2 cash columns here. And we want to start with the assets of the company. And we'll bring the non-current assets. So all you do is go to the statement of financial position given. You see PPE. Remember, don't be tempted to go and add Adler, because Adler's figure is not going to be added because Adler is an associate. Okay, so we won't take Adler's figure. We'll take only Piquant and Sander. So property, plant, and equipment, we see 37,500 plus 24,500. So PPE, you write that in full, 37,500 plus 24,500. Remember, we mentioned under the net assets, the post-acquisition adjustment here, plus the 2,000 minus what? 100. Told you about that. Minus 100. So you do that adjustment. So when we punch that out, we are going to be getting 63,900. That's our PPE. Next item is investment. Now, remember, this investment is what is going to be replaced by goodwill. So you bring in your goodwill. We did a workings for that. Let's go pick it up. Workings 8, 12, 200. Then we need to bring in, as part of the non-current assets, investment in Adler, the associate. We did a workings also for that. Let's go pick it. This is it, workings for 13,200. So from there, you come to current assets. Can you see that? Current assets. So it means we are done. Let's add it up. As per my working slide, that is going to be 89,300. Then we bring in the current assets. Under the current assets, let's go. Let's see what we got there. We see inventory, 10,000 and 9,000. 10,000 plus 9,000. Remember the goods in transit when we're doing the reconciliation, the goods in transit of 1,006, I told you about it. Sorry, 1,008, I told you about it. So we bring it 1,800. Then we did, you add it, sorry. Then you subtract the provision for unrealized profits we calculated, which was 600 as per my thinking. Yes, 600. Here is it. We deduct it. $600. So we do the arithmetic. I want to make it well. So 1,008 minus 600. So that will be in the first column for me. Arithmetically, when we punch that out, that is going to be 20,200. Okay. Then from there, what's the next thing? Trade receivables. Now, when you are bringing trade receivable, you have to remember the reconciliation we did. 6,500 plus 1,005. So trade receivables. 6,500 plus 1,500. But we will deduct the reconciliation we did. How much? Trade receivables. We are going to deduct 3,400. The piquant figure. When you punch that out, that is going to be 4,600. Okay. Next item. Okay, that's all. Then it gives us total assets for the period under consideration. So when you add this up, it's going to give me 24,800. So you add that up and that gives you total assets. So when you add that to the 89,300, we will get 114,100. 114,100. 114,100. So that is the total assets. Then we need to do the second slide, that is equity and liabilities. Now, because of space purposes, I'm going to do it on the next sheet. Equity and liability. We first bring equity, and when it comes to equity, only the parent issues will be brought. So let's go. Equity, we see equity shares of $1 each, 25,000. Of $1 each, 25,000. Then we see share premium, 19,800. Then we will bring the next item there is retained earnings, but don't pick this figure. You're going to pick the one we did the workings for. So retained earnings, that's the consolidated retained earnings. And you did the workings for that, so we could go pick it up. And that is in workings 3, 27,500. $27,500 in that case. So We add that up. That gives us an amount of 72,300. That is called the equity attributable to owners of the parent. Okay, equity attributable to owners of the parents. Now we need to split this between, we need to split equity between the NCI and then the owners. So we will bring in the non-controlling interest. And we did a workings for that. Let's go pick it up. Non-controlling interest is in workings 7,8400. We bring it up. You now add it up, and that gives you the total equity of 80,700 in that case. That gives you total equity. Okay, so that is how you get your equity when preparing the consolidated statement of financial position. That's how we get our equity when preparing the consolidated statement of financial position. Then we bring in the liabilities. In the liabilities, we go to the financial statement. What do we have? We see non-current liability, 7% loan notes, 14,000 for this one, 2,000 for this one. So 7% loan notes, 14,000, and then 14,500, and then 2,000. Sorry. That gives us an amount of 16,500. Let's go. And then that is the only non-current liabilities. So we bring in the current liabilities. We didn't bring the headings though. So under the liabilities, we have the non-current. Then after that, we bring the current liabilities. So under the current liabilities, let's see what we got. The first thing there is, all we see is contingent what? Consideration. Remember that this contingent consideration, it's no longer the 4,200, but it was what? It's now 2,700. So we bring it up. Now, the reason you are bringing this consideration up is that it is still an amount you owe to the shareholders. Not you don't owe the money to the subsidiary firm. You owe it to their shareholders. That is why that 2,700 will still be coming up in that case. Then we see the last item, other current liabilities. So that is 8,300, 7,200. So other current liabilities. 8,300 plus 7,500. Then remember the reconciliation of the trade payable. We're going to deduct that. That is in workings 5 or working 6, and that's 1,600 in Sanda. So you deduct that 1,600, and that gives us an amount for the outstanding figure in that case. And when we punch that out, that's going to be 14,200. And that is all based on the financial statement, and we've brought everything up. So you add that up, and that is going to be 16,900. You add that to the equity and then the non-current liability, and that gives you total equity and liability. Total equity and liabilities. So when we add that up, it should give you, as per my workings, 114,100, which tells us that our balance sheet has balance. So this is how we look at the consolidated statement of financial position. And that's the answer to the question on Sunday. That's the answer to the question on Sunday. Now, you realize that, like I say all the time, we do the workings first. So you see, if you rush to come and extract the financial statement, let's say you come and rush and extract the financial statement. Okay, you bring the parent figure, the subs figure. How about the other one? Okay, you do it, then you bring it up. Nah, we don't mark what is in the bracket. You get a tick on this side. You get a tick on this side. This is the side you're going to be getting the tick. So that is why I tell you all the time, don't rush and go and extract financial statements. Read the notes one after the other. Go through it step by step. As you read, you solve. As you read, you solve. As you read, you solve. Don't read all the questions and ask yourself, where the heck do I start? Don't read all the questions and ask yourself, where the heck do I start? This is what you must understand when it comes to dealing with the consolidated financial statement in that case. Any questions for me? Some comments coming in on YouTube. Let's see. Al-Hassan Sadiq said, you are a blessing to me and many. May you be blessed by the grace of Almighty Allah. It's always a pleasure. Yep. Thank you. And may Allah bless you as well for joining us. So any questions for me? That's it about consolidated statement of financial position. Now, in the exam hall, how far can the examiner go? The items the examiner can talk about, intra-group trading, the sales that occurred, NCI value, impairment in goodwill, it's going to be just around the same thing. It is the fair value of consideration transferred that sometimes the examiner can mess up with your brain a little bit. But again, if you are strong with your accounting standards, you shouldn't screw it up. Because I've told you that in the consolidated financial statement, your accounting standards play a key role as well when it comes to dealing with the items in that particular case. And that is what you need to understand when we talk about a consolidated statement of financial position. That's what you need to understand in that case. Okay, I think I'm seeing a video of someone. Al-Hassan, is your hand up? Okay. You can unmute and ask your question. You could have raised your hand digitally on the Zoom, but I think you didn't know about that. So just go ahead.
Thank you, sir. And good evening to you and to my colleagues on this.
All right.
Usually, I want to find out, during constructing or preparing the consolidated statement of financial position, do you have to do the workings before you come to the extract, as we usually see on many of the materials? Sometimes they prepare the extract and you see the workings after the extract. So
okay,
sometimes
it's about presentation. You could see
yes,
that
please.
As per what I have done, I did all my workings, then the financial statement is finally there. So it's presentation. And because you don't want to leave too much space or overleave space, you start with the workings. The most important thing is numbering and writing the right headings down. So if I write workings, everything I did from workings 1 to workings 9 there, then I now go to A, consolidated statement of financial position. So it depends. If you want to bring that first, fine. But then why will you bring it first if you do the workings before coming to that? So it's about presentation. You can bring it first, then the workings follow, or you bring the workings first, then the financial statement follow. Like I say all the time, because I want you to read the notes one after the other and do the workings before the extract, do all your workings and let the financial statement be the final thing you're going to be presenting.
Thank you.
All right. Any other questions for me? Let's see if I got other questions. Lamini said, God bless you, sir. Amen. God bless you too. Hey, this name, I can't even pronounce the name. Oh. The name is hard rough. Sorry if I don't mention your name right on YouTube, okay? Itumelin, forgive me if I don't mention it. I don't even know. You're making my ACCA journey very easy. God bless you abundantly, sir. Amen. And God bless you too for joining us. Sorry if I'm not able to mention your name right in that case. Okay, so that's basically it. And that's our discussion on the consolidated financial statement. Like I mentioned yesterday, we are looking at hosting some 4 intensive sessions where I want to guarantee you 50% minimum in the exam hall, where I'm going through specific issues with you like ratios, ethics, and then the standard. Now, these 3 things, minimum of 50% waiting for you in the exam hall. So we're going to be hosting a session, 4 sessions on those subjects, or sorry, on those topics related to corporate reporting and financial reporting in that case. But those are going to be paid session. So you keep on following me on Instagram. Details about that will be posted, and the time for it, if it is favorable for you, you'll be able to join, and how much you're going to be paying and all of those things will be posted on my Instagram page, because we are planning on doing that, so that after that 4th session, it's a guarantee that you are going into the exam hall with an assurance of minimum of 50%, hands down, to be able to work it out, do it in that particular case. Because you know ratio is going to be there. If you are guided on the interpretation well, you can get a greater portion of that mark. You know ethics is going to be there. If you are guided on your answers and how you write it out, you're going to be able to do that successfully. You know the standards is going to be there. There are key standards we need to focus on, and certainly the issue about the consolidated financial statements, just going through the workings again so you can pick up the marks small like that and see how it goes. So that is it about it today, and thank you very much for joining me on the live stream. Scott Tamba said, thanks for the help, always a pleasure. Gloria Jones said, thank you, sir. You are welcome, Gloria, and thanks for joining us. So that's it about it. God willing, tomorrow I'll come your way, same time, at 4:30 p.m. and we will do something else, probably not related to corporate reporting or financial reporting. But follow me on Instagram if you are not, at Nhyira Premium, and details will be posted there. If it relates to something that you are doing, then you can join us on the live stream in that case. But tomorrow we will be streaming on YouTube, on Facebook, as well as on LinkedIn. In that case, there will not be any Zoom session, because when we use the Zoom, it limits the channels on which we can stream simultaneously. So tomorrow we're going to be going back to our traditional streaming. So we'll be on Facebook, we'll be on YouTube, we'll be on LinkedIn, and probably on Twitter as well, because we are integrating that as well into our system in that case. So that is it. And thank you for joining me. I'll catch you same time tomorrow. But like I say all the time, don't end here. For those of you who are learning under my mentorship, you have your question kits. There are a lot of questions in consolidation in your question kits. Try your hands on them, and then you send them to me. You know the drills already. I'm going to look at it, provide you with some guidelines so you can prepare well for the examination in that case. See you same time tomorrow, and stay safe. Bye-bye.